Hello, my name is Madison Dooley, and today I will be giving a presentation on Peachtree Case Study A. So the first question pertains to the T-bond return in Table 1. And the T-bond return in Table 1 is shown to be independent of the state of the economy because a Treasury bond is a fixed percentage issued by the U.S. government. It will stay the same no matter what the state of the economy is in. The return on a one-year T-bond is also risk-free. Okay, so the answer to the second question is that the expected rate of return equals the sum of the products of probability and estimated total returns. The expected rate of return on each of the four alternatives is as follows. The T-bond is 8%, TECO is 13.5%, Gold Hill is 8.8%, and the S&P 500 fund is 15%. The investment with the highest return is the S&P 500 fund with 15%. And coefficients of variation. These statistics measure risk by calculating the standard deviation and coefficient of variation. The coefficient of variation is the better measure of returns, while the standard deviation is the better measure of a stock in isolation. When compared, the alternative with the highest standard deviation is the S&P 500 fund with 16.43% and the highest rate of return. Next is TECO with a standard deviation of 11.72%. Gold Hill has a standard deviation of 9.09%. And finally, the T-bond has the lowest standard deviation of 0%. Forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in TECO. The portfolio's expected rate of return is 11.15%. The standard deviation is 2.75%, and the coefficient of variation is 4.0424%. In comparison with the individual stocks, the expected rate of return falls within the range. The standard deviation falls in the lower range, and the coefficient of variation is largest in comparison. By having two investments of equal weights in a portfolio, it proves to have lowered the portfolio's overall risk, or standard deviation. If 75% was invested in Gold Hill, the standard deviation will decrease to 1.63%. When 75% is invested in TECO, the standard deviation will increase to 3.57%. This is due to the differing amounts in returns in each alternative. So the question for number 5 is to now consider a portfolio consisting of $10,000 in TECO and $10,000 in the S&P 500 fund. The effect on the portfolio reduces risk to 1.58%. This is due to investing in the two highest investment returns in the portfolio. Investing in higher returns gives you a lower risk factor. And here are the values that I obtained from my Excel spreadsheet. The rate of return is 14.25%, the standard deviation is 36.94%, and the variation is 15.63%. The coefficient of variation is 2.3631. For number 6, suppose an investor starts with a portfolio consisting of one randomly selected stock. Theoretically speaking, a portfolio's risk would decrease as more and more stocks are added to the portfolio, thereby contributing to the diversification of the portfolio. The implications for investors is to ensure a well-diversified portfolio to reduce risk. And it is not a question of how an individual stock affects a portfolio. Rather, it is about if there is a well-balanced amount of risk in total stocks within the portfolio. This would, of course, affect the company's cost of capital. Market risk is the possibility for an investor to experience losses due to factors that affect the overall performance of the financial markets. Diversifiable risk is simply risk that is specific to a particular security or sector, so its impact on a diversified portfolio is limited. Total risk is the sum of systematic and unsystematic risk on an investment. If one was to hold a single stock portfolio, the losses associated with that investment can be enormous. One should not expect to be compensated for all the risk that one bears. Diagram using the S&P 500 fund as the y-axis and then the other three possibilities on the x-axis. And the slopes that I got for each one is as follows. The T-bond is 0, Gold Hill is negative 1.83854, and TECO is 1.42302. The slope coefficient is simply a linear regression. The significance of it is that it is the unstandardized coefficient that is calculated for the raw or unstandardized data. In other words, it is the amount of change in y due to a change of 1 unit in x. So here's the security market line I calculated, and all it is a representation of the capital asset pricing model. So what would happen to TECO if the required rate of return of inflation increased by 3 percentage points, above the estimate embedded in the 8.0% risk-free rate? Well, the required rate of return would also increase by 3 percentage points, from 13.5% to 16.5%. If the market risk premium increased from 7% to 8%, then the required rate of return for TECO would increase as well to 12.8%. And this is done by the calculation of 0.08 plus 0.08 times 0.6. If the beta increased from 0.6 to 1, then the required rate of return for TECO would increase as well to 15%. So what is the efficient market hypothesis? The impact that EMH has on decisions affecting the investment in securities is that it basically tells the investor that it is impossible to beat the market. The EMH is not applicable to real assets such as plant and equipment. The effect that EMH has on corporate financing decisions is that it allows the stocks of the corporation to be sold at their fair value on stock exchanges. This takes away the possibility of undervalued or inflated prices on stocks. Jake Taylor should be concerned about the EMH when he considers adding to his staff of security analysts. This is because the theory requires that all information pertaining to the stock be reflected in the price, making it practically pointless to hire someone to do any technical analysis. So question 10 pertains to the long-term debt ratio, and the definition is that it is a measurement of representing the percentage of a corporation's assets that are financed with loans and financial obligations lasting more than 1 year. A decrease in the long-term debt ratio would decrease the corporation's riskiness, since the corporation is shown to being more responsible in paying off its debt. Since the riskiness would decrease, then so would its beta, given that beta is a measurement of risk. In theory, the rate of return on equity would also increase, since the total assets would increase from a decreasing long-term debt ratio. Thank you.